Good afternoon, everyone. Thanks very much, Chelsea. As Chelsea said, my name's James Stephen. I'm the Director of Wealth here at Aintree Group. Today, we're talking about how we manage money. It's going to be more specifically around the portfolio side. Previously, when we've done it, we've looked at the overall wealth management and the concepts we look at in there. So today, we're going to keep it around portfolios and leave out more the strategic financial planning side. But before we get started, I just got to put the disclaimer that goes up there each time. Effectively, it's really just saying that, this is general information and we haven't considered your personal circumstances, so you can't assume that we're directing this directly towards you. But obviously, if you want personal advice, give us a call and we can address it at that point. So today on the agenda, I've just sort of gone through a brief introduction, but our agenda is we're going to look at how we approach investing, how we add value, as well as investment concepts that work, that have stood the test of time, and maybe just to give you a bit of an understanding of sort of via sort of nice, concise charts, how things actually work out there in the investment world. Additionally, what I'd like to do, objectives I'd like to achieve today is to give people some assistance. Even if you're managing your own portfolios, you might be able to find a few concepts here that can help you out, or even some things you might have been wrestling with and not quite understand. This can help you understand those, either through the presentation or through the Q&A at the end. And we want to keep it simple. We don't want anything to be overly complicated. And the way we manage money, as you'll see going through in terms of the general approach, is as simple as possible. Life's complicated as it is. We try to avoid adding any unnecessary complication to your lives as well. So anyway, let's get started. Let's have a look at the general wealth building concepts that we will approach. So we look at your goals and objectives. That's obviously important, because whether it's normal strategic financial planning or portfolio management, you still got to be clear on what you're trying to achieve. We also want to make sure that with the portfolios, they're properly balanced. You don't want to over allocate your assets towards one particular area, because obviously things go wrong. And we'll explain why and give an example of how every asset and every investment has its day in the sun. Costs are important. We talk about them as well. The discipline of staying the path. Our core satellite approach, how we go through, how we actually specifically will allocate the funds. And then the personalization, because everyone's a little bit different, and it's important that when we build a portfolio, we take into account your values, your objectives, and things that are important to you. So we'll go through these now, and you can give you an example. So first and foremost, with the goals, regardless of what you're trying to achieve, it doesn't matter whether it's finance or going on holidays or doing anything. You want to know what you're trying to get out of it. And some exact examples of what we would do with goals is a common one is retirement. Most people that we see at some point in their retirement planning journey or their financial planning journey want to address retirement. Big question is, how much do we need? How long is the money going to last for? And what's the best way to make it last? But the thing most people don't understand is how much you need. So what we'll do is we'll work with them to understand that. There is plenty of metrics out there where it's explained as to what a comfortable retirement looks like, and we will take them through that. But that is a clear-cut goal that people can look at, and it's measurable. And it's attainable because there is the evidence behind it, and it's known as the retirement standard. So if you Google the retirement standard, that has been running for about 20 years, and it takes people through a budget on how much you need to retire if you want a comfortable retirement for a single person or a couple, or just a modest retirement. But it shows you how the numbers are calculated, and it shows you what sort of lump sum you need. And for us, that's great, because at that point now we've got a goal which we can measure it, and we can make sure it's achievable and practical for people. Another example is school fees. We often get asked, how are we going to fund our kids' education? And first and foremost, we need to know is how much that's going to cost. And how do you find that out? Well, you typically go to the school, you speak to the bursar, you find out what the general fees are there, and also what's the average rate of increase over the years. I did that for one client. It was Wesley College we were looking at, and I spoke to the bursar then, and they'd been increasing their fees by about 8% per annum. Which was very important to know, because when we're planning for the future and we're trying to get a goal that's we can measure and try and achieve, we needed to get specifics. And if we'd just gone with like the current fee plus CPI, we'd end up with an inappropriate number, because using 8%, the actual cost will double over 9 years. Whereas 3%, it'll be nowhere near that. So this is an example of how we go about that. We have to drill down and actually get that number. So that's why goals are so important, whether it's any type of objective you're trying to achieve. Next up is balance. And balance, we're talking about asset allocation particularly, and diversification. So when you're investing, and we actually go into this asset allocation concept in far deeper way later on in the presentation. But asset allocation is crucial in terms of what outcomes you're going to get. So this is where we'll spend time with people to work on their risk profile, as we call it, and that's based on your age, your experience, and your objectives. And that will actually determine the assets we invest in. So that's why it's so important to get that part right. And you'll see later on how much of an impact that makes on your returns. It's getting that asset allocation correct. But not only asset allocation, we want to make sure that with your assets, they're broadly diversified, because we don't want to put all our eggs in one basket. We want to make sure that regardless of which type of assets they're in, it's not just in a handful, it's in many. And for most people, it's actually in many thousands. So we don't have to, if a company goes bust or a segment of the market struggles, it doesn't actually impact your portfolio significantly at all. The idea is that we're not trying to shoot the lights out or get an unreasonable return. We're just trying to get our share of the market return. Then costs are important too. So when we're looking at a portfolio, one thing we're always looking at is how do we reduce the cost of that portfolio? Because all things being equal, if you're paying more for something that you could get for less, you're going to get a worse outcome. So every additional 1% that you're being charged through the overall process is going to obviously impact your returns by 1%. So where possible, the way we go about it is we're trying to find the best managers that can offer a good price, the best investment platforms or super funds, or even in other areas like insurance. We're trying to get the best price. Doesn't mean it's trying to be cheap. It's got to be good value for money. But it is important, so we always keep our eye on the cost. Then we get to discipline. Now, once we're up and about and the money's been invested, discipline's important, because the thing about discipline is, for most people, investing is a long-term exercise. So you have to stay the course, and sometimes it can feel like, it's boring, or the markets are doing nothing, and you want to do something different, or the markets are falling, people starting to panic. When markets fall, it's very hard to maintain discipline towards those objectives. People will often want to pull out of the investments for a while, just till things sort of settle down. But as we'll show later on, that's the worst approach you can take. And I'll save that for when we get to those slides. But discipline's important. Once we've set our course, we want to stick to it, and that's every month in, month out, adding money to our investments, not making impulsive decisions, knowing that we're on the right track, and knowing if we stick to it, we'll achieve our goals, and not getting sort of put off by events that are happening around us. And then in terms of specifically when we get to the portfolio, the way we like to look at it is we build a portfolio with what's called the core satellite approach. So the core of our portfolio is going to be a very diversified, low cost investment. Typically, that'll be what they call passive investments, where it's tracking an index. So why we do that is we know there's low turnover, there's low fees, but we're getting broad allocation to the entire markets. So we know that part will help us achieve our fair share of the market returns. And then the sort of satellite approach is where whether we believe it's the case or our clients want to sort of tilt their portfolio to a particular area of the market that they think is a good approach going forward, maybe through their interests. They might be in the healthcare sector, they might be in consumables or some sort of sector where they feel like there's some tailwinds behind them and they want to allocate a bit extra to that. So that's a satellite approach, and that's where you can potentially get better returns than the market. But we don't want to put everything into those bets, so to speak, just because the future's unknown. Whereas if we have most of it in our core holding, we know we're going to get our fair share. And then obviously it's personalized, I suppose, which is the next point as well, but personalized to what you're interested in. And then the final bit we have is screens. So once we've worked out exactly where we're heading with our portfolio, what type of mix it's going to have, we have the ability to put a screen over the portfolio. So what that means is if you've got a particular interest in like a sort of issues that are deep, that you hold deep feelings towards, like climate change or human and animal right abuse, or particular areas of the market you don't like. You might have a problem with the banks, for instance. Some people don't particularly like the banks. It could be mining, it could be anything. So what we can do is we can overlay screens across that portfolio to pull out all assets related to those areas. So previously, why this is a good option is previously what happened was if you were concerned by climate change, as an example, you could only select funds that invested in the appropriate assets, which meant you only had a very limited amount of funds you could put your money into. Whereby, like, if you think that there's thousands of options out there, but there might only be 15, 20 funds that specifically pull out polluters or miners or anything that's going to affect the climate that bother you. Now what we can do is we can say we can offer every investment, but we can put a screen and pulling out anything that's not appropriate. So you get the best of both worlds now. So that's the overall approach we'll look at when we're investing money, and then we'll drill down a little bit deeper so we can see how all those pan out. So when it comes to portfolio management, a group called Russell Investments, which have been around for about 80 years, they're a global company. Each year they look at how can advisors actually add money, and they try to put a percentage on it, depending on what tools are available to the advisors. So they've come up with potentially up to 5.8%, depending on where your portfolio obviously is positioned at the time and your personality as well. But on average, it's about 5.8%. And there's three little pieces of the pie here that make that up, and that's what we're gonna talk about, is how we can add value using our approach. So the first one is asset allocation, and asset allocation it makes up, depending on which research you look at. The lowest I've seen is 85, but I've seen plenty at up to 95%. It shows that if you get your asset allocation right, it's gonna generate the vast majority of returns you're going to get. So I suppose a way to look at it is, if you're in the right assets, even if you're in poor versions of those assets, you're still going to get most of the returns of those asset classes. So example is shares. You might not be the best share manager in the market, but you're still going to get most of the returns the share market does. Now, compare that to someone who's invested in cash and fixed interest. They might be in the best version of that, but that asset class is over the long term trail shares significantly. So it doesn't really matter whether you're in the best one of an asset class that's not correct. You're not going to get anywhere near the share market return. So it's very important to get the asset allocation right. And to get the asset allocation right, what we do is we spend a lot of time on the risk profiling, which I mentioned earlier. And the risk profiling will determine what bucket of assets you invest in. Now, that bucket of investments is what's going to generate your returns. So an example of how this 1.6 additional value would be calculated is most people just go into the balance fund. When they set up a super fund, they're in the balance fund. So each super fund has a My Super investment option, and that's where you go. If you don't make any selection at all, you go in there. Now, they all have a different way of doing it, but as an example, most people will be in the balance fund in Australia. So that's probably about 70% of people will be in that. Under this example here, over 60% are going to be in that single asset allocation. So let's have a look at that one for a moment. So here's an example. It doesn't look like it's come through very clear, but I'll just explain this slide. This lady is invested in 80% growth assets. Now, 80% growth assets for her might not be appropriate for what she's trying to achieve. So if she was to, she's in this example, I apologize, 70% growth assets, which is a growth portfolio. Now, if we spend a bit of time with her and work out what type of return she needs, and we work out that she's better off in 80% growth assets, the difference between those two over a period of time of 10 years works out to be about 1.4%. So if you think about 1.4%, she'd be 30% better off, or $30,000 better off if she'd just been in the 80% shares in property versus 70%. Now, if she didn't know any better, she'd just sit in the balance in the default allocation. But because we worked with her to work out what was the best for her, we came to the conclusion that it was 80%, and that in itself will generate the higher return. So it's very important for people to spend time getting this piece right. I mean, even if they didn't work with an advisor, we'll show you that ultimately, if you want higher returns, you need to take more risk, and you need to be in higher growth assets. Otherwise, you may not achieve your outcomes. But what you will do, even if you, regardless, you'll get lower returns over the long term. And we'll go through that and show you what I mean. So with asset classes, if you look at, we're going to take you through a 30-year return rate and a 52-year return rate. At each stage, the share market, whether it's Australian shares or international shares, will do significantly better than cash. So the top here, well, it's not super clear here, but the top here is US shares, and then there's Australian shares here versus cash. So regardless of all the events that happen along the way, the ups and downs, that would include things like the GFC or COVID, they all had a major impact on the share market, but didn't stop this relentless climb. Now, if you compare the shares to the cash, if you were just sitting in cash, your returns are going to be, doesn't matter, it could be the best cash manager in Australia. You're going to get nowhere near the returns of the shares. So that's why it's so important to be in the right asset classes. And we can go here again, the 52-year returns. Now you can see here, I mean, this is the US share market's done exceptionally well, which goes to show when you're looking at a diversified portfolio, you don't just look at Australian shares. You want to look at global shares as well, because it's a big world out there, and we only make up 2% of the market. So this is why when we look at portfolios, when they're talking about diversification, They want to make sure that when you're not just involved in Australian shares, you're involved in global shares, US shares, European shares, Asian shares, all of those different options, because they all over time deliver a different rate of return, but it gives you a better return than all the other asset classes. Here's another example of what we're talking about, the day in the sun. So if you look at all the different asset classes here, these are the returns each year of those asset classes. So there's never any one year when one does better than the other. As you can see there, sometimes they do really well, like Australian shares before the GFC had 4 really good years, 2004, 5, 6, 7. And then after that, it tailed away a little bit compared to the US and international shares, which did better long term in that period afterwards. So that's why we have the diversified portfolio. But as you can see, regardless of the ups and downs of the market, long term, the average of these asset classes, the share market did better than some of the other markets, like the cash market, of only a very small percent here compared to 10, 11%. So I suppose, we've shown a lot of charts, but the point here is regardless of what timelines you want to use, being in the right asset classes is going to dictate the vast majority of returns. So when we spend time with people, we want to make sure they're in the right asset classes. And probably the easiest way to show it now, just to finalize this part of the topic, is if you look at these funds here. This is Vanguard, which is one of the largest asset managers in the world. They manage about $9 trillion, which is about 3 times Australia's GDP. So they're significantly large. And what they've done is they've got 4 investment options here, and each one has a different amount of shares and cash and fixed interest. So the people who want the safer in portfolio, in their minds, have the Vanguard Conservative, which is 70% cash and fixed interest and 30% shares. And over here, you've got 90% shares and 10% fixed interest. And you can see over most timelines, the more growth assets you have in your portfolio, the higher the returns. And this is a 20-year track record. So over the inception, the 10 years, the 5 years, the 3 years, the 1 year, pretty much at all times, regardless of what the markets have done, regardless of whether we've had COVID or the GFC or whatever, the asset allocation you're in dictates the majority of your returns. So that's why it's so important. I know I've gone through that a number of times on the slides. I just thought I'd really make it clear, because I feel like getting that piece right is going to get almost everything right for you. And the second bit of value add here is one that is very common for us, and we spend a lot of time with clients in this, is behavioral coaching. And what that means is, people talk about the markets being driven by greed and fear. And when people are investing on a long-term timeline, what happens along the way is it's the journey is where things come unstuck for them. Is whilst at the start, everybody's in the right portfolios, they're ready to go, they believe that this is the right approach, they've seen all the slides that I've shown, they understand that markets go up and down, but still a lot of people don't even get the same return as the index. And when I say an index, it's just simply a basket of companies that match the index that's been created. So the S&P 500 is the top 500 companies in the US. So this index is made up of those 500 companies. So the average investor here over a 20-year period underperformed the index. And that's because they kept trying to time the market, trying to go in and out of the market when they didn't need to. And it's not, and the reasons could be a number of reasons. Some of the reasons are markets have fallen. You had the GFC, you had COVID, you had European crisis, You've had a whole lot of different things, and people get concerned, and then they want to pull their money out and wait till things get better. And then when the markets go up, they miss that increase. So that's one of the common reasons. Another common reason is people get bored. People get bored of just investing and not doing anything. They want to do things, they want to make changes, they want to improve things, they've read something, someone's told them something, and they want to try to get a better outcome. But unfortunately, what it all leads to is a dramatic underperformance. And the difference between 6% and 9% is huge over the long run. I mean, an example of what people miss as well, if you don't look a little bit deeper, is the ASX 200. So that's our Australian top 200 companies. In 2007, which is 16 years ago, it was valued at 6,696. It was its value then. At the moment, it's 7,193. So over 16 years, it's increased by 7.4%, not per annum, in total. So it's easy to get bored when it does nothing. You're looking at this market going, the Australian share market has done nothing for 16 years. But if you look a little bit deeper and you look at what's called the accumulation index, which includes the dividends, not just the price of those companies, but the dividends they've paid, that has increased by 111% over that period. So, on one hand, everyone's looking at you turn on the news and the news report, they've said the All Ordinaries is up by 1%, or the ASX 200 is up by 1% today or down. But over that period, that's done nothing. But then you include all the dividends and you're up by 111%. And that doesn't include all the money you put in each month to build up your portfolio. So these are the things that get people sidetracked. It's not just the falls and the scares, but it's also just boredom. So that's part of behavioral coaching, is just getting them to hang in there and understand that the real value is not chopping and changing at every new thing, every new shiny ball that comes out. And here's another example. I mean, this is even easier to understand. Is they looked at what's the impact of missing the best days in the market. If you were just invested the whole time, you did nothing, you did not try to time it, you didn't do anything, that your 100 grand over a 10-year period was worth 243,000. If you missed the best 40 days, just the best 40 days over 10 years, that's 3,650 days, you missed 40. Look at the difference just by being out of the market for 40 days. And that's what happens. People get out. I mean, when I first started, one of the guys in our company, I mean, this is not a good example of what to do. This is a bad example. But his clients would come to him when the markets are falling, and they would be scared. And he would say, "Oh, okay, well, we'll put it in some cash, something safe till the markets improve." Point is, by the time they've improved and you've noticed it, you've missed out on the upswing. So I say to people, even if it's scary, you don't like it, and you're getting bad news all the time, just don't look at it, because within a couple of years it's back to where it was. So here's probably the example that I'm using here, is that they talk about bull markets and bear markets, or bear years and bull years and bear years. The bull is when the market's going up, and the bear is when it's going down. Now, the thing is, the bear markets go down for a very short period of time. Most of the time, the market's going up. So what happens with the downturns is they happen quickly. This 30, I think it's 33%, was 1.3 years. This 42% here was, not even half a year. You had over there was the GFC was 1.3 years before it started going up. And over here was COVID. It was down 27%. It wasn't even in a year, and it was starting to go back up again. So this is the time to hang in there. But not only hang in there, this is the time to actually invest, actually put your money into the portfolio. because you can take advantage of the lower costs and you can start increasing your portfolio value when it inevitably goes up. And here's just one more slide to demonstrate just the regular contributions just hanging in there, month in, month out, just continuing to put your money in. So if you just put in 10 grand and you didn't do anything else, it's going to be worth 750 after, this is a 32-year timeline, so it's a long time, or 40 years. But adding, additional amount of 500 a month makes a huge difference over that period. And you can see the difference. And that's just not trying to time the market, not trying to get any better returns than anyone else. It's simply just putting the money in the market, putting it every single month. So that's what I mean by boring. It's not supposed to be exciting. You set your course. You know what you want to achieve. You know what the plan calls for. And you just have to do it. And if you do it, when you get through this period to the retirement or your financial independence or whatever your goals are, you'll have the outcome you want. But the challenge is staying the course, and that's where behavioural management comes in. And this is just another slide. We might just skip past this one because this is sort of on a similar theme. And the third sort of area of value add is tax-aware planning and investing. So it's just important that all things being equal, you're in the right structures for your personal position. And obviously that's where the accountants come in to make sure that you're set up correctly. We're not tax experts, but we do know that, each structure has its pros and its cons. And for a lot of people, superannuation is the one with the best outcome for them. And particularly when you get close to retirement, superannuation is a very, very effective structure for you, because when you're close to retirement, you don't have long before you can access it. You don't have the risks of the government changing the rules. I know they change them all the time, but once you're in there, you tend to get the rules that were around at the time you started. They typically tend to make any changes down the track for people so they can have time to plan properly. But it's not just super. There's other options out there, like super investment bonds or family trusts, different structures. But obviously that's where you want to work closely with either the advisor or whichever advisor. But at Aintree, we work as a team here. So when we work with our clients, we try to get input from everyone just to make sure that we haven't missed anything. And, it was looked at from all angles and all areas of expertise. But those three areas, the three key areas which add the extra return, the value out on the portfolio management. Whilst it might not be sexy type of stuff, it's the bread and butter of investing is simply getting the right assets in the right place for your objectives, staying the course, not being put off by the next shiny thing, and just making sure that your assets are in the right buckets, the right structures, to make sure that you're not paying too much tax, because tax is a part of life, and it can have a very big impact on what type of returns you get after tax, because all the returns along the way, typically, it's your gross returns, but it's the after-tax returns are the ones that you actually have to live on. So we get those three things right, and for most people, they've had significant value added to them, and that's where we feel we can add the most value to your situation when it comes to investing money on your behalf. And then we'll look at some concepts, just some basic concepts here that we can sort of take you through and give you a little bit more understanding about the markets themselves. We've already covered off on this, that over the long term, getting it into the right bucket is going to have the best outcome for you. You can see the this is I mean, we haven't sort of cherry picked a 10-year period. This is, you know, a couple of 100 years. So it's covering a lot more than most people's lifetimes, I'd say. I don't think there's anyone who's been around since 1801. But you can see the difference between getting a solid 6.9% return versus getting 2.5%. Huge over that period of time. I mean, it's millions. So that's why that goes back to that same old process. Also, you know, you make far more money holding through the bull markets, because we showed the diagram that they go for much longer than bear markets. So and the value of the bull market, the market increases much more than it falls during these bear markets. Hence the point of just staying the course, because you got to get through these little blips along the way, because they happen. And even when they're a massive one like the GFC, when you look at it in context, they still are dwarfed by the bull markets. So you know, the reason I've shown multiple versions of these slides, I really want to get the point home that you know, it's you got to look through all the negativity when times are tough, or your natural inclination to try to tinker with things or play with things. And that also goes back to, and that's what exactly I said, is the average investor versus investors who just invested in an asset class. You know, this is your class 60/40 is your classic retirement portfolio. If all people did was just sit in that over a 20-year period, significantly better than the average investor, because they're not messing around with you know, different ideas or timing the market. They're just investing in it. Man, really, what does get people most times, and this is where the average investor will get themselves in trouble, is that they get caught up in the emotion of the market. When times are great, everybody wants to buy. Everybody's happy to get into the market. Everybody believes they're going to make some money, but then inevitably the market will have its dips, and that's when people want to sell. So the problem is they're buying up here, they're buying high, and they're selling low. When really what you're trying to do is you're trying to make sure you're just buying along the way. And ideally, if you've got some spare funds, the time to buy is this bit down here with the trough, the get me out part. This is when successful investors will buy. They'll look at that and they'll go, this is good value. You know, like if Commonwealth Bank is fantastic at, you know, $104, it's way better at, you know, $60. And that's the way people look at it. So still the same business, nothing's changed. CBA is still, you know, maximizing their profits. They're still overcharging people, you know, on their mortgages, not paying enough on the term deposits. They're going to make plenty of money. So when would you rather buy them, at 104 or 60? And that's that's the mentality you want to take into this investment journey. We'll skip through that one. And you know, this is just stock market losses over the journey. Most times, it's very rare along a significant period. This is around about 80 years, 90 years, that you get a really big fall. They're not very common. So most times, the vast majority of the falls in a year will typically be in the 5 to 10% range. So there'll be opportunities to increase your holdings along the way. But because most people through super are regularly investing every month, they're going to access those each time without even probably thinking about it. And that helps build up their overall returns over the long term. And this just shows that just each year you don't know what you're going to get. So this is why, actually, this is probably a good example of why when you've got some cash and you know you need to use it in a couple of years' time, maybe you want to buy a property or you want to go on holidays, and quite often I get people go, where should I put it? Well, the thing is, you literally don't know what's going to happen next year. No one knows. We don't know if it's going to be an up year or down year. We know most years are up years, but we don't know for sure that the next year will be an up year. So that's why it's important. If your timeline isn't long enough, it's better to put it in safe cash type investments, like fixed term deposits or high yielding cash accounts for those periods. But if you've got a solid 10-year period, definitely you want to go for the right asset class, because over the long term the market trends up, so you want to catch that wave. Now, reasons for sell. So this is what gets people as well. There's always some reason why now's a good time to just get out of the market, just wait it out. There's always something, and it's most years there's an event. Throughout history, you could probably go through each year and look at what was the biggest event each year. There's always something scary, but inevitably the market just deals with that. It might fall for a bit, but companies like using the Commonwealth Bank example, just because we have, like COVID, Commonwealth Bank's still Commonwealth Bank. It's still doing its thing. It doesn't matter whether it's COVID or the GFC or it's, like with different things here where we got like Ebola virus or any of this sort of stuff. It's just noise. And these companies are still going to do their stuff each day, each month, each year. So importantly, as we try and explain along the way, these events or these good reasons to sell it, just ignore them and just keep contributing, keep sticking to the plan. Whilst it's boring, it's what works. Politics, that's another thing. It really just doesn't matter. It doesn't matter who is the politician. So if you're investing based on whether it's the left team or the right team or the red team, blue team, whatever you want to call them, it's not going to make any difference. It doesn't matter whether it's in Australia, US, Australia, or anywhere really. The market is just a representation of the global or the domestic business market, and every single year businesses are trying to improve. They're trying to increase their profits. They're trying to increase their revenues, decrease their expenses, and this goes on and on. That they invest back into the business. They invest in new technology, new ideas, new people, new processes, always trying to get better. And the companies that don't do well get replaced by other ones. So when you look at the investment markets, the ASX 200, the S&P 500 in America, the same companies aren't always there. As soon as a company falters, they get dropped out of those indexes, and then the winners come in, the next best one. So there's always made up of the best 200 companies or the best 500, and that's why it keeps growing. Because any companies that are losers in this capitalism market, they just get kicked out, and the next ones come in. So it's a constant cycle of just the better companies just keep being in that index, because that's how the index is designed, to keep the best ones there. That's why it keeps going up. Also here, this is just a basic example of what drives returns. Is when you look at in any one year, any of these factors could determine whether the market goes up or down. Like this yellow one, here's the multiple. Like when share markets are very buoyant and people are very excited to invest in them, the price to earnings ratio is what they talk about. It goes up. It means people are prepared to pay more for a company than they were last year. But over the long run, it basically comes down to profits. The profits are the thing that matters. Are you increasing your profits? Is this company getting more valuable? And that will dictate the returns. So that's why you've got to ignore the noise and just look at what are these companies doing? Are they making more money? Yes. Well, then over the long term, they're going up. And this is just another example. The longer you hold, the more chance of success. That's why over shorter periods, it's not a guarantee by any measure. You could easily lose money if you're investing for a short period of time. But once you get past a certain point, this 5-year mark onwards, your chances of success are very high. So hence why if you stick to the plan and you do it consistently, these long-term periods will see you achieve your outcomes. And this is why behavioural management is so important, because we just got to get people to stick to it. And well, I think I discussed this one. There's periods where markets can go sideways, do nothing, like that example I used with the Australian 200. But beneath the scenes, beneath the surface, there's still the dividends are still getting paid. These companies are still making profits. You might not see it day to day, but you'll still be making money even when they're trading sideways. But you've got to be prepared for it, and that's where people get bored. So that's just reinforcing that point again. And this is just a new thing it's not new. It's been going on for probably 30 or 40 years particularly, but if you look at that, you can just see the amount of changes going on. These are the new companies, new concepts coming into our markets. So there's new value being created all the time. So the beauty of the way the markets are set up in terms of investments, for the way we invest for clients, is when you look at the ordinaries, the ASX 200, the American top 500, the NASDAQ, these sort of companies are constantly popping up in there, and they're new companies, new ideas, new value. I mean, look at all the things here that we've got. You've got DNA computing, you've got cloud computing, which we obviously, a lot of people use the cloud. I mean, that's just a common part of business now. We've got, obviously, like with the electronic car, artificial intelligence is a big one people are talking about at the moment. I mean, asteroid mining, that's obviously a bit out of left field, but there's just unlimited amount of new tech coming on. It's coming on faster and faster, so value's coming more and more. So it's just a case of, you just want to make sure you get your fair share of that, because the human endeavors are improving all the time. We're constantly changing and evolving. So I just feel like, and it's an exciting time for people, and it's why we've got to be invested in the best asset classes, which is going to be your shares. Cash and fixed interest are not going to give you any of this. They're good for the short term, but long term, this is where we want to be. And probably the final slide here is, you just got to start. If like somebody said, well, okay, well, gee, I've missed out on all that, I haven't done anything. Well, it doesn't matter. The sooner you start, the sooner you're going to get some of the outcomes that can be generated. But regardless of whether you started late or early, I mean, even if you start late, you're still going to be better off than you were if you didn't do anything. So that's probably the way I would look at it. So I know there's been a lot there. There's a lot, and I just want to really just hone in on that. If we go right back to the start, we just remember that it's all about some core concepts. We simply want to make sure that we know our goals and objectives, we get the right asset allocation, we diversify properly, we keep our costs low, and we stay the course. We just continue holding our nerve, staying on the path to achieve our objectives. And if it calls for putting money in every month, that's what we do. We just do it regardless of the market conditions, because we know that whilst there's a new scare all the time, there's a new problem, historically speaking, the markets have always progressed upwards. And that's really that sort of hope for the future that we've got to focus on. And obviously with your portfolios, you can tweak them a little bit personally, like I said, with a tilt towards something you like. It doesn't have to be a big tilt, but it can give you a bit of interest in the overall journey, because it is a long journey. So having a little bit of interest in it will be a good thing. But also on the other side of that is the screens, where you can personalize it a bit more to something that you feel passionate about. But we can help you with all that along the journey. We're bumping up against time. We said we'd get to 1 o'clock would be a hard close. So, and I did say if there's any questions, we'll allow some time. So, Chelsea, I don't know, were there any questions?
We haven't had any come through in the Q&A or the chat, so I'll just open up the floor to anyone who does have a question or anyone who wants to make a comment. I know we've got Shane online as well, who I'm sure has thoughts from the tax perspective as well. And we also have some of our legal team members who may have some perspective from their end as well. But anyone, the floor is open to ask some questions if you want to either pop questions in the chat or the Q&A box, or you can unmute the microphone and ask directly if you'd like. Feel free. While giving everyone a chance to think of their questions, I have one for James in terms of the just start mentality. In terms of people who are just starting, how flexible is the amount of money you would suggest to start for someone creating a portfolio who wants to have a solid foundation and a nice diverse portfolio to begin with? Is there sort of a minimum savings that you would suggest, or is it flexible depending on their goals and amount of time to retirement and things like that?
Yeah, well, assuming it makes sense for their current position. I mean, like as an example, if they had a huge amount of credit card debt, I'd probably say pay that off first. But let's just say, you know, everything was all on track and they were ready to start investing. The way it's set up now is you can get access to a fully diversified portfolio for a very small amount of money. And, you know, you can buy it through an ETF, exchange traded fund. You can buy those, just as an example, we had those 4 funds, the Vanguard funds, the conservative, the balanced, the growth, high growth. They're already pre-mixed portfolios. So you buy that with even $1,000, you're going to get access to the global share market. It's Australian, international, and that's not just the international, is US, Europe, Asia, everywhere for a small amount of money. So there's no actual the minimum's very small. You just need an amount to justify paying the brokerage when you buy it. But yeah, even $1,000 will get you started. I mean, that's probably, yeah, I would say, as long as you had a specific plan of attack and you knew you wanted to grow your wealth, you could start with a small amount of money and you want to set it up so that every single month you're putting money in, you don't even think about it. I mean, Vanguard's personal investor option, which is what those 4 portfolios are from, I think they've set it up so you can just invest for no brokerage. So you literally can set it up with them. So you're putting in $500 a month into your option. It's fully diversified. You don't have to pay anything, and they'll just do it for you. If you want to go down that sort of DIY approach.
Thank you. James's contact details will be in the follow-up email and in the slides as well. So if anything pops up after the presentation, definitely feel free to get in touch with our wealth team and James, and they'll be able to help you out. Thank you very much, everyone.
Thank you. Bye.